Welcome to Larking Gowen Insights, accountancy and business advice for all, a series that gives you bite-sized tips and guidance on tax, funding, legislation, reforms and much more. With case studies, business advisory and sector specials and even interviews, our team of experts are committed to helping you navigate the world of accounting and finance with a variety of presenters from across our specialisms. So, let's get on with today's show.
Hi everyone, my name is Bridie Iachetta and today I will be talking about the taxation of cryptocurrencies and generally crypto assets, which will apply to just about everybody who is looking at or has already gone into those types of investments. So firstly, what is crypto in general? What is cryptocurrency? What is crypto assets? So cryptocurrency is a digital medium of exchange that occurs throughout a computer network technology known as the blockchain. It is a self-monitored and self-structured medium of exchange, and it isn't relying on any kind of bank, authority or intermediary. So it is self-serving, which is mostly its USP outside of general legal tender. Cryptocurrency isn't legal tender either. So this is something to be very aware of because they do not work the same way as pounds, dollars, and so on and so forth. Mode of transactions were devised to make an audit trail impenetrable. This is why the blockchain is so different to every other kind of currency that we understand outside of crypto assets and cryptocurrency. It is close to impossible to counterfeit or fool the system because of the way it works. The blockchain is very, very clever and very unique. So this also makes it very secure. So there's no human interaction, and the transactions are approved by a crowd of nodes. You can't see my air quotes, but nodes, little digital eyes that see the transaction happen between the purchaser and the purchasee, for example. So the only participants involved is the person purchasing and the person selling. And these digital eyes see the transaction happen. If enough of the eyes see it, they say, yep, that is done, and it is added to the blockchain. So it is very, very self-serving. And that is why the blockchain is so different and so unique. And that's what makes cryptocurrency a very, very different beast to what we understand in any other kind of investments or currencies that we have prior to crypto. However, the downside is that they are unregulated and decentralized, which is a USP in some sense, but it's quite a risky prospect in another sense. So for lots of people, it's a high risk, volatile type of investment, type of trade. So high risk, high reward for sure. Its value is hinged almost entirely on its popularity. It's a peer-to-peer exchange. Because it is decentralized, it is not pegged to any other kind of economy or any kind of exterior item as such. So if lots of people want it, it's worth a lot of money, and if nobody wants it, then it's not worth an awful lot, which is not how legal tender such as pounds and dollars works. So that is a very quick overview of cryptocurrency and crypto assets. In a nutshell. So the main types of cryptocurrency that you will have heard of will be things like Bitcoin, being the one that you will read most about in the news, but there are others that are very popular, such as Ethereum, Binance Coin, Litecoin, Polkadot, Bitcoin Cash. There are over 2,500 types of cryptocurrencies in existence to date, and these will only grow, no doubt. There are also different types of crypto assets. Now, crypto assets are an overarching umbrella term, and cryptocurrencies are a subdivision of that. So the different types of crypto assets that you can have are exchange tokens. They are your common ones, such as Bitcoin, Ethereum, and they're used as a means of payment and investment, trade, exchange. So they're quite fluid, quite versatile types of tokens. They can be converted into hard currency as well, like pounds, dollars, euros, etc. Then you can go on to other types of assets, utility tokens, for example, which provide the holder with access to particular goods and services on a particular platform. So they're a little more restricted. Then you'll have security tokens, which provide the holder with rights to or an interest in a business, an ownership share, entitlements, so on and so forth. So again, more restrictive. And then you can go into things like stable coins, which minimize the volatility that Bitcoin and Ethereum will be exposed to, because they attempt to peg themselves to something that has a stable value, such as precious metals, government-backed currencies like the dollar, stuff like that. They're a little more, they are moving towards a centralized system, which potentially could limit its USP or actually heighten its USP, depending on sort of whether or not you're a high risk or a low risk type of investor. Most people generally will be hobbyist investors, people that will invest legal tender hard currencies into crypto assets, buy and sell exchange tokens to make gains or potentially earn a passive income, similar to share investing. Not the same, but similar. Other ways of obtaining crypto beyond trades and just flat purchases and flat sales. So the main ones that I'm going to talk about today are mining. This is where people excavate or digitally mine for new tokens by verifying additions to the blockchain. Now, because the blockchain is impenetrable, as such, this is done by solving cryptographic puzzles on a computer, very complicated math problems, and again, excavate additions to the blockchain, create coins. Well, not create, but find coins. Don't ask me to elaborate on that because I absolutely can't. But that is the general gist. You can get things like airdrops, where someone receives tokens as part of a marketing or advertising campaign, in which people are elected to receive certain types of tokens by being part of one of these campaigns, or where someone is registered to become eligible to take part in these airdrops. So that is another method. There's also a thing called forking, and forking is very interesting, actually, because crypto is not controlled by a central body or person, as I'll go back to, and it is operated on a consensus of the peers who are investing in that particular type of asset. So within the crypto community. So when there is a majority vote where they want something to be different or something to change within a certain type of assets, they may create a fork on the ledger, the blockchain. So this is broken down again into two different types of forks. You get a soft fork, which is just updating the protocol for everyone and no new tokens or ledgers are created. So it's just a consensus of change. And then you have a hard fork, and this is where new tokens are created off a branch, off onto a new ledger, almost like a copy and paste. But the blockchain forks. So it is still part of the same pathway, but it is forked like a road. And then new tokens have a shared history with the original tokens. Bitcoin Cash is an example of a hard fork from Bitcoin. So yes, there's lots of different ways you can obtain coins, and we will now move on to the taxing of crypto assets. So generally, capital gains tax will apply for most hobbyist investors. This is done by calculating the sterling value. Well, we're talking UK here, so we'll find the UK sterling value of those assets at that particular time, and we will take the sterling value at disposal, the sterling value at purchase of that particular asset, that particular type of currency, and that will be the difference between will be the gain or the loss that you make on that particular investment. But a disposal for tax purposes is not always when you dispose of your coin and withdraw it as UK sterling. That is not your only type of disposal. A disposal will also occur when you exchange one token for another. So if I wanted to sell some Bitcoin in order to buy some Ethereum, that is not an exchange like you would if you were going on holiday and you exchange your pounds for euros. It does not work like that. So you are technically disposing of a Bitcoin investment and you are purchasing an Ethereum investment. So there is a disposal and an acquisition all in that one transaction. So that is something to be aware of, and often people will misunderstand that type of transaction. So it is not a taxable event just when you take it out as UK sterling or dollars or wherever it is you may be taking it out from. It is when you are disposing of any coin for any reason. If you use Bitcoin to buy a service or you buy another tangible asset, then that is also a disposal, indirect disposal. So just to be aware of that. Now, the other thing as well that is not always made obvious is the situs of a crypto asset, so where that asset lies. So the resident, I won't say the residency, but the situs of an asset is matched to the owner. So whilst you could see some crypto assets and you can withdraw them as dollars, that does not make them a US asset. If they sit with you and you are the owner, because they are not pegged to any kind of cited asset, they will be treated as resident in the country that you are in. So you will have a UK asset if you have Bitcoin and you are a UK resident. So that's something to be mindful as well. The only alternative to that is if the crypto you have is attached to an underlying asset, which will be quite rare but not impossible. And then the situs will be attached to that underlying asset. So just something to be aware of. Now, sometimes cryptocurrencies will be exposed to income tax as well. So this is where your activities amount to a trade. And this is a question of facts. So if you are doing mining and things like that, you are providing a service, you are performing a duty in order to obtain that type of coin. So it will be seen as an income earned. So, or if you're being paid in cryptocurrency rather than cash. So if you are being paid in Bitcoin, that Bitcoin will be received, exchanged at sterling value for the sake of taxation purposes, and taxed as income as if it would if you were paid in cash. That is also something to think about. So you have to think whether or not it's been received for goods or services. Have you provided goods or provided services in order to receive that type of currency, that cryptocurrency? Then it could very well, in fact, be an income tax liability. Mining airdrops sometimes fall into that category depending on the structure of how you're receiving those airdrops and whether or not it's trading, employment income or miscellaneous. So it very much depends on why or how you're obtaining those types of coins. So the other thing I will just quickly touch on is inheritance tax. Now, cryptocurrencies are considered by HMRC to be property for inheritance tax purposes. So this means that they will make up part of your estate when you pass. So depending on your domicile as well, the type of asset you hold, they may be taxed under inheritance tax rules in the UK. So again, that comes back to the situs of where cryptocurrencies actually are seen as sitting. So if you're a UK resident, so on and so forth, they'll be seen as sitting in the UK. Now, the other thing I haven't discussed just yet, and that is actually growing in popularity, are NFTs. NFTs will stand for non-fungible tokens, and they are a non-interchangeable unit of data stored on the blockchain. So these are not the same as cryptocurrencies for the reasons I will go on to explain. So usually these are associated with digital files of art, photos, videos, audio. So they are backed to a certain type of generally creative asset, digital assets. And they are uniquely identifiable. Unlike Bitcoin, you can have 1, 2, 3 Bitcoin and they are all pooled into the same type of asset. NFTs have a unique identifiable watermark barcode that makes them singular. You cannot pool NFTs. They are individual items. So they're not the same as the usual blockchain asset that can be put into a pool and split and collected. They are not the same thing. They are individual. So NFTs can be sold, traded, but not exchanged because they have a unique digital signature. And so basically they are like having a digital painting on the wall. That is the brief overview of cryptocurrencies and the bits you will really need to think of if you are an investor. So if you have invested in cryptocurrencies, be it a trade, been received as income for any type of work you've done, then this is something that perhaps you will need to go and speak to a professional about, because it is not as straightforward as it seems, certainly not. And it's best to get advice to see where you stand with these types of investments, how they've been received, how they've been withdrawn, and the movements within those certain wallets and assets that you have. So do get in touch with one of our experts, and we will certainly help guide you through.
Thank you for joining us for Larking Gowen Insights, Accountancy and Business Advice for All. Don't forget, you can find more information about today's topic and more about how our team of experts can help you in your business by visiting our website, larking-gowen.co.uk. Join us again next time for another fascinating insight into the world of accounting and finance.